In this week's Funding Our Future, we take a look at Americans' debt levels during the pandemic. And like me, you may be surprised to learn there hasn't been a big increase in overall borrowing. According to the Federal Reserve Bank of New York, total household debt rose less than 1.5% to $14.5 trillion in the fourth quarter of 2020. Here to talk about it now is Michael Collins, director of the Center for Financial Security and professor at the University of Wisconsin-Madison. Professor Collins, thanks so much for being with us. So, we might expect, at least I thought, we were going to see more people turning to credit, turning to banks to help, pay the bills, including the rent and so forth. But you say that didn't happen. Why not?
Yeah, it is surprising. I think a lot of it's expected to be, people borrowing on their credit card to get by during the pandemic or, other kinds of activities like that. But we really didn't. And so some of it is certainly the support that people got from pandemic assistance and stimulus. A lot of it is that people just weren't spending for a long time. They were staying home. And so, they weren't doing those big splurges. So we really haven't seen a big increase in debt loads overall. We've seen some increase in auto loans, for example, as people have bought cars in the last, 6 months or so. But still, it's pretty modest relative to what we might have expected.
So then I'm wondering if as those programs roll back and go away, as moratoriums on things like student loan debt and rent get lifted, do you expect to see a spike? Because the next big cliff is going to be the supplemental unemployment insurance. It's going to expire. That extra $300 a week going to expire September 6th. Do you believe we're going to see a spike up in borrowing after those kinds of events?
Yeah, so I think we're going to see a few things going on. I mean, you mentioned that some of the forbearance efforts are out there, and almost every federal student loan right now has basically a payment pause. So that's 22 million loans out there where people are not making payments. There's about 8 million auto loans, about 5 million mortgages. So that's another way that people are making ends meet, is they don't have to make these regular payments. And so, like you said, all these programs are kind of ending in the next few months, and even student loans early next year. And that's going to mean, a lot more tightness of people's budgets. And already in some of the census data, we're seeing people saying they're having trouble keeping up. So, I think there is some concern right now that we might see people trying to turn to credit cards or, struggling to try to make ends meet.
And when people are borrowing, Professor, where are you seeing them borrow the most, and for what kinds of things?
Yeah, I mean, the biggest increase we've probably seen is around both mortgages and autos. The mortgage market, the housing market is really hot, but it's kind of a double-edged sword. So if you're in it, then that can be a boon to you. You can, obviously get access to a house, and maybe that house appreciates in value. But there's a lot of people who are out of that market, and we've seen lenders, not necessarily making loans as available as they were before. So, and for people who've been unemployed or who've had spotty and unstable income, it's going to be harder for them to get kind of those loans in the future. So I think we've heard about this sort of K-shaped recovery where some people are, taking advantage of low interest rates and doing very well, and others have more risks. I think that's going to continue over the next year as we come out of some of these programs.
Who is most vulnerable right now when you look at those people who may have to borrow just to make ends meet? Is it the younger folks? Is it minority groups? What are you seeing?
Yeah, it's about, if we look at the census data, it's about 1 in 4 people who say that it's somewhat difficult or very difficult for them to just keep up with their regular household expenses. So, it's 1 in 4 people. It's not nothing, but it's definitely higher among, I thought it would actually be higher among the people in their young 20s, but it's actually people in their 20s and 30s. That's where we see some of the most struggle. It's least problematic for people 65 and older. But certainly, as you mentioned, by race, there's a really big effect. It's about 20% of white households who say that they're having a somewhat or very difficult time keeping up with their usual expenses. It's about 37% of black households, so a much higher rate, and it's about 32% for Latino households. So we definitely see a big difference by race, and that obviously is concerning because those might be the folks who are most benefiting right now from some of the forbearance programs and some of the other stimulus programs that are out there.
Mm-hmm. How does borrowing and debt levels now compare to other times in our history? I guess most recently, the Great Recession of 2008 and 9.
I get asked that question a lot because, it seems like we should have learned something from the last go around, but this is such a different kind of environment. The Great Recession in 2008, that was a lot of mortgages against homes that were dropping in value. And today we have mortgages that are against houses that are increasing in value in sort of a pretty hot housing market. We didn't really see a big run up in credit card debt, for example. So it's a very different kind of environment. I think the biggest issue for some people is getting access to credit. So it's not that they can't manage the credit they have. It's that they would like to be able to borrow to buy a house or borrow to buy a car at a better interest rate. So the access issues are maybe just as important today as the default issues were back in 2008.
All right, we're going to have to leave it there. Professor Michael Collins, thanks so much for being with us today. Appreciate those insights. And a reminder that Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans.